Welcome to the Morningstar Investor Summit India. My name is Mohit Agarwal, and it's my pleasure to start today's event. The summit is a unique opportunity for all of us to come together and explore the latest trends and insights in the world of investing. Today, we have an exciting lineup of speakers and experts who will share their knowledge and experiences with us. As we kickstart this event, I want to take a moment to acknowledge the challenges that investors face in today's complex and rapidly evolving financial landscape. It all started with the COVID pandemic, then the geopolitical tensions, supply chain crisis, macro challenges like rising inflation, and an impending slowdown as we are all facing. This volatility and uncertainty in the markets has made it difficult for even the most experienced investors to navigate. But as India and the world strives to overcome these challenges, we as investors have an opportunity to reevaluate our strategies and consider new opportunities for the long-term growth. And that's exactly what this summit is all about, discovering new ideas and approaches that can help us achieve our financial goals. This event for individual investors is an opportunity to drive our mission at Morningstar, that is to empower investor success in everything we do. I'd also reiterate Morningstar's commitment to helping investors achieve their financial goals through independent, objective research and analysis, innovative products and services, and a culture of collaboration and integrity. So without further ado, let's get started. I hope you're all as excited as I am for what promises to be an informative and an inspiring day. Thank you for joining us at the Morningstar Investor Summit India. I now invite Kaustuv Belapurkar, Director Research, to take forward the agenda to a very insightful discussion with industry stalwarts, Nilesh Shah of Kotak AMC and Sankaran Narayan of ICICI Pro on the topic of investing in turbulent times. I'll also ask one of my colleagues to put on the agenda on the screen for everyone to recap and get started. Thank you.
Good morning, everyone. Thank you for joining us early on a Saturday morning. I'm Kaustuv Belapurkar, Director of Fund Research at Morningstar India. And, so like Mohit very well articulated that we're living in interesting times, right? In terms of, the discussion today, is investing in turbulent times. And what we've seen over the last few years has been nothing short of tumultuous. We've had the COVID pandemic. We had a very sharp correction in the markets, driven by, increasingly sharp recovery in a very quick span of time, driven by global liquidity. Last year was, a roller coaster ride again. We had early signs of the pandemic subsiding, economy coming back on track, but then we had the war in Europe, the energy price shock, supply side issues, which really pushed inflation into a territory that we've not seen, especially in the in the global markets for decades, right? Global central banks have obviously been aggressively raising rates, but at the same time, you have very large global economies standing at the precipice of an impending recession, right? So what are the implications for our own Indian economy and markets? What are some of the long-term investing themes for Indian investors? How should investors be looking at investing right now? To discuss all of this and more, we're joined by two of India's finest investors and stalwarts of the Indian mutual fund industry. So it gives me great pleasure to introduce our speakers for today. Nilesh Shah, the Managing Director and CEO at Kotak Mahindra Asset Management, and Sankaran Narayan, Executive Director and CIO at ICICI Prudential Asset Management. So Nilesh, Narayan, welcome to the second, Morningstar Investor Summit. Thank you for joining us. And, we really look forward to this discussion. And I believe, through so many of my past discussions with you all, I've come back enriched with a lot of new ideas and, that increasing conviction about India as a stories and investment thesis. So we really look forward to carrying forward these discussions in the next, 45 minutes. So welcome and thanks for joining us.
Thank you, Kaustuv, for inviting us.
Same from my side, Kaustuv.
Sure. So just before we get into the discussion, just some quick house rules for the audience. We will be taking, I know you all have a lot of questions to ask Narayan and Nilesh, and we would love to take as many of those towards the end of our conversation. So do put in your questions through the Q&A tab, and we will have Narayan and Nilesh kind of address some of the common queries that come about. Before we start the discussion, I want to actually just ask my colleague to put up a poll that I wanted the audience to take up to really set a tone for the discussion. So if you could have the poll, thank you. So obviously, we've seen the markets have been volatile. So what are you as an investor doing? And what are some of the changes that you're looking to make to your portfolio as of now? So if you could vote, and then we can take forward the discussion from there. We'll probably give it 30 seconds more before we close the poll. Okay, so just some context, and we'll talk about it a little more in detail later. But I think these are some great responses that are coming about. Almost half, the audience is saying we're sticking to a set allocation, which is great to hear. There's an increasingly great number that's also talking about increasing equity allocation. So that I think broadly it's really good directionally to hear what investors are thinking. So I think before we get into a discussion on the economy and the markets, there are there's a diverse audience here, that's present today, and a lot of first-time investors who've either very recently invested in the markets or looking to get into the markets. So my question to you, Nilesh, if you just dial back time and tell us, what got you interested in investing? How did you really start your investing career? It'll be, great insights for the audience to hear.
So I was doing my articleship in Fort Chambers A, which is behind Stock Exchange. I saw people becoming rich very quickly, and I thought I'll also become rich very quickly. I jumped into the market in the 91-92 era, lost everything, and it was a very painful experience. That kind of started my investment career. I'm thankful to God that He gave me a very, very nice experience at a very, very low cost, though it was very painful in the beginning. And then one thing led to another. The journey continued over 3 decades. And today also, I'm student of the market. Every day market teaches new thing. There are few principles which haven't changed over the last 3 decades. And there are few things which keep on changing every day. So it's an exciting journey, but clearly one has to be student of the market rather than guru of the market.
Absolutely. Thanks, Suresh. And like you rightly said, it's always a continuous learning journey. And we really hope to tap into, the immense amount of experience and wisdom that you have, for the benefit of our audience. And similarly, you've obviously seen so many market cycles in your investing career, be it the Asian financial crisis, the tech bubble, the home boom and bust of the infrastructure capex led in the mid to late 2000s, obviously the global financial crisis and many more. What have been some of your learnings, and how has that shaped your investing philosophy?
The real learning came from the 94 to 98 cycle. In 94, 5 years after starting to invest, I thought I knew everything. And then 94 to 98 till the Asian financial crisis, you lost almost everything. And then you learned that you didn't know anything about investing. And after that, you learned that greed and fear is more important than knowledge. And you actually realize that temperament is a more important thing in investing, and you have to recognize greed and fear at all points of time. And 2007-8 again taught us the same thing, that greed and fear is more important than anything else. And that doesn't affect only India, it affects everywhere in the world. And from that point onwards, I would say that, we have learned that if you manage temperament and if you create products like the Balanced Advantage Fund, which focuses much more on temperament rather than anything else, you can actually create a good investing story for the long-term investor. And that has been our biggest learning, that, people are so focused on thinking that they can make money out of the last bit of news. But it is, if your goal is to make money in the long run, it is temperament which helps you, and the ability to avoid getting carried away by the news of the moment or the mood of the moment. That is what helps you to make money. That is like, using the COVID moment and seeing that stocks have crashed to buy aggressively, or using the moment where people were willing to invest in stocks without earnings to sell equities at a point of time, even globally or in India. And that is what helps you to make money. So the ability to manage temperament, use temperament to make money is the biggest learning that I have, and that is what we at ICICI Prudential have been also trying continuously.
Sure. Thanks, Ren. And I think very well articulated, both Nilesh and Ren. So it's a continuous learning journey. Temperament really matters, and that's what will hold you in good stead over the long term in the markets. So just moving on to Nilesh, in terms of looking at the current scenario. Obviously, we've just kind of looking like we're reasonably okay with now the pandemic seems to be behind us. But there's this whole overhang of the war in Europe that's carried on for probably a lot longer than what people expected. Recession is looming in some of the global economies. How do you think that's going to have a trickle-down impact on our own domestic economy? What are your thoughts about what are some things that you would be watching out for?
So undoubtedly, global events will continue to impact our economy. If those events turn out positive, then there will be positive effect. And if not, then negative effect. So far, in the deteriorating global backdrop, Indian economy has done well. 6 out of top 10 fastest growing cities last year were in India, that is CY22. Hyderabad, Bangalore, Delhi, Chennai, Kolkata, Mumbai, these were the fastest growing cities of the world. The state where I belong, Maharashtra, today produces as much GDP as whole of India was producing in 2005. In about 16, 17 odd years, states reach where the country was before. Same thing as about states like UP and Uttarakhand, Tamil Nadu, Karnataka, and Gujarat. Effectively, these 5 states over next 2 decades can reach where India is today. So these 5 states alone will end up creating 5 India in terms of GDP over next 2 decades. If you look at our companies, they are now trying to be globally competitive. Forget the companies, even cooperative society is aiming higher and higher. Amul is India's largest market cap, largest FMCG company, turnover of 61,000 crore. They are targeting that by 2047, they will be world's largest FMCG company with 18 lakh crore turnover. Now, anyone making such statement, we will think it is fake. But this is Amul, no ordinary company. In 1970, India was producing milk, which was equivalent to 16% of Europe's milk production. Thanks to Amul, today it is 150%. If Amul can lift India from 16% to 150% of Europe's milk production, if it can make India world's largest milk producer, why can't it make the largest FMCG company of the world? So we are in an economy on a long-term basis where cities are doing well, states will become as big as country, and companies will become leading companies of the world. Now, in this journey, will there be speed breakers? Of course, yes. There will be global events like you mentioned, Russia-Ukraine war situation, US Fed pivot, energy prices, global flows, and there will be local events which will also impact our economy. How RBI manages monetary policy, what happens to the monsoon, which is likely to be impacted by El Nino this year. What will be the impact of, variety of events around us. So in the short term, there will be many impacts, but in the long term, will India continue to grow and become the 3rd largest economy of the world over next decade or so? Answer is undoubtedly yes.
Sure, Nilesh. I think that's a great perspective about really where the growth drivers for the Indian economy stand, and really how we're on a great footing. domestically and internationally. Then in terms of, just kind of a bird's eye view in terms of what are some of, the mega themes that you were looking at, from a multi-year perspective that could really propel our economy going forward?
Actually, India is in the stage that every theme over the long run, whether it is consumption, whether it is infrastructure, whether it is debt, any of these themes are likely to do well in the long run. Because India, if you look at any per capita financial services, almost every theme that you think of, manufacturing, exports, you look at any indicator, you'll find that, India has the largest working age population, sooner or later will be in India. So almost all the themes will do well over the next few decades. It is just that at various points of time, some theme will be cheaper in the stock market and some other theme will be costlier in the stock market. So you will have to identify the themes where the risk return reward ratio looks good and then choose that theme. But all themes will do well, but you have to choose the right theme at the right moment. And that is how we see it. And that from that framework is how we think about investing over the next 20, 30 years. And that's how we believe returns can be made. Even if you look at the past, it is not that infrastructure is not going to grow. But if you go back to 2007, the theme had become too costly. If you look at pharma in 2015, pharma had become too costly. So if you look at IT in 2021, 22, some of those stocks had become costly. So at various points of time, what happens is different themes get overvalued because the fact is everyone looks at the last 2 years growth and actually extrapolates it for the next 10 years. And that last 2 years growth need not be the next 10 years. And it can be too high in the last 2 years. Therefore, they extrapolate it for the next 10 years or vice versa. So they look at the last 2 years growth and say it's too low. And they extrapolate it for the next 10 years. So we get all these opportunities to actually move from one theme to another also. Because some of the themes tend to become cheap and therefore you get that opportunity. But as such, India is a good destination, which will be volatile and therefore give you opportunities to make money. But many of these themes will work in and one after the other also to make money.
Sure. Thanks. I think those are some fair points. Just come back to, Nilesh, in terms of, there's one thing that's spoken about very often over the past 1 year, the China plus one sort of, theme that people are talking about. So how powerful is that, that and compelling is that story? And, where can we really grow in that space?
So China plus one is a penalty goal given to us. And because in the past we were not good at converting penalty goal to the goal, this time God has ensured that the goal post is wider. The goalkeeper has been put to sleep. The ground has been tilted. So even if we push, the goal will be scored. But as India, I still have to go and kick the ball in right direction. And in the past, I have done self-goal rather than goal against the opposition. 14% of companies which are moving out of China is coming to India. Now that's an encouraging start, but our end destination should be 50% of company, not 14%. In mobile phones, we have seen companies coming out of China. Samsung now operates world's largest single location mobile handset manufacturing plant in Noida, UP. In mobile phones from importer, we have now become exporter. But what we have done with mobile phones and electronic components, we need to replicate in many, many, many other sectors. This is a long-term journey where we have taken a start. It's promising start, but please remember, we have a long distance to cover. In 1980, India and China were at similar per capita GDP and GDP. Today, they are 6 times ahead of us. That's the kind of distance we have to cover, capturing this China plus one opportunity. And again, I will warn that we can't afford to score a self goal or a low goal. Samsung came to India many, many years before they discovered Vietnam. It's an unlisted company, but they are India's largest consumer durable company. Their turnover will be in the region of $12 to $13 billion. In Vietnam, their turnover is $65 billion. Vietnam is 1/10 the size of India or lower. And yet Samsung has 5 times more turnover in Vietnam. When Samsung came to India, we couldn't lay a red carpet. We couldn't provide opportunities which Vietnam provided. So China Plus One is an opportunity for us so that going forward, some other commentator does not have to speak about how India did not take advantage of Samsung.
Sure. Nilesh, I think that's some really great insight right there. And just taking that conversation forward, Naren, you spoke about infrastructure and we've obviously seen the great CapEx infrastructure led push that, even the government has been doing over the past many years and increasingly so in this budget. And just alluding to what, Nilesh touched upon, do you see, that being a huge enabler to India's economy, all the roads and ports and railways, just your thoughts, how that could kind of push us into the next league?
It will be, but like Nilesh mentioned, these are all areas where India finds it much, much more difficult because it is a democracy. And, when you are a democracy, you have to satisfy a lot of interests. When China goes about it, because it is not like a democracy, the decision making is extremely fast and they don't care about many things. So the way they are able to do things is much, much faster. In India, for example, there are small stretches of the dedicated freight corridor, which is not executed because of, I would say, democracy. And that is where the challenge comes, and due to that, you're not able to execute. Whereas this would have never been allowed in China to have happened. And that is the challenge in executing infrastructure. And, sitting in Mumbai, all of us, the speed with which some of the metros have happened, has been much slower than what we would have wished. Again, because, the amount of time that has to be taken in certain decisions between different interest groups just delays decision making, whereas you have to take those decisions. For every decision, there is a pros and a con, but then you have to take those decisions and move forward. Those decisions sometimes on where to put the metro shed, I think is a decision that has taken years and delayed a project which is so important to improving infrastructure in Bombay. And that kind of framework means that infrastructure improvement in India is much slower than what we would want it to be. Just to add to what Nilesh mentioned, all this China plus one, Europe plus one, all these challenges have come in manufacturing. But if you take the entire services landscape, I think there's no one to beat India. And, sitting in Morningstar, you yourself would know that the entire global support that Morningstar in India would be able to give Morningstar globally is unmatched. And there is nothing like China plus one there. It is India, India, India. And you should see the recent data now on services export. Services export is zooming. It is not ordinarily zooming. It is zooming extraordinarily. And, there it is not China plus one or Europe plus one. It appears to be, it is India, India, India. And there is no plus one business. And, sitting in Morningstar itself, you will recognize that there is no other country which can compete in the quality of manpower and the cheapness of manpower in those areas. So luckily for us in manufacturing, we have so many other countries to unluckily compete with, like whether it is sometimes Thailand, sometimes Vietnam, sometimes Bangladesh. But as far as services is concerned, I think others have to do the same thing and find how can they compete with India. And that has been a revelation for me, the kind of services export growth we have seen in the last 3 to 6 months.
Sure. Very rightly said, Ren. Obviously, it's multiple pillars of growth that we can see in the economy. Like Nilesh, you mentioned, it's manufacturing, it's infrastructure led, it's services, all of that. Obviously, there are certain bottlenecks, but otherwise, I think we're from what we hear that we're really on a very strong footing for multi-decadal growth for the Indian economy. Just moving the needle in terms of investing processes and markets, and that's what investors want to really hear the pulse that you see. Nilesh, to start with you in terms of as a more growth at a reasonable price investor, looking for margin of safety and in buying the right businesses. How easy or difficult it is in a market like this. If you could just throw some light about how you and your team are doing that.
See, it's never easy to make money. If making money was easy, all of us would have become billionaire and given competition to Elon Musk and Bill Gates. But it's not that easy. At the same time, if you have discipline, you will eventually come successful. At Kotak Mutual Fund, our job is very simple. We know our boundaries and we operate within that. One thing for us is corporate governance. In the past, we have made many mistakes on governance side and learned that lesson at a high cost, that there's no point in investing with people who are going to take you for a ride. Fortunately, now regulator has also empowered us to protect our minority rights. So using the past experience and the power given, we are by and large invested into good governance companies and ensure that they remain on the path of good governance. The second thing is related to valuation. Obviously, price is what you pay and value is what you get. Now, there are periods where certain stocks continue to run higher and higher. You underperform your peers or benchmark indices because you took a different call from them. Now you have to stick to your guns. You have to absorb those periods of underperformance. And today, I can proudly say not only Kotak Mutual Fund, but entire mutual fund industry has come out with flying color on avoiding expensive stocks. Even when they were part of benchmark indices, even when the whole world was populating the myth that fund managers are not generating alpha, all the mutual fund managers stayed away from the temptation of investing into expensive stocks. And that has been proven right now. So as Naren mentioned, it is all about balancing your greed and fear. It's all about maintaining your sanity when the market becomes irrational. Over a long period of time, markets are like weighing machine where fundamentals will play out. We are not a momentum player. We are not a flow player. That game you can play on few thousand crores, not on few lakh crores. So we are fundamentalist. We will bear period of underperformance, but eventually come out with flying colors.
Absolutely, Nilesh. I think, the proof of the pudding is, you and your team have really had this well-articulated investment process that you have, applied over so many years, decades rather. And like you said, underperformance is, temporary, as long as the investment process is great and steady, the performance pays off, and we have seen that over market cycles. Naren, question to you. I mean, obviously, just putting your contrarian hat on, you've been early in identifying so many, those beaten down, unloved names, as you call them, and you've been patient to hold them while many others ignored them. So what is your sort of philosophy in time which enables you to do that? And maybe some of the sort of top-down themes that you're kind of looking at right now from that perspective.
See, actually, it's too easy. Finally, at the end of the day, you want to make money. And, it's only in the first year where it's a problem. Finally, how it works is that if you're bought in year one, in year four, you'll get the return of what you bought when it is unloved in year one. So it is at year one to year three where there's a problem. And what happens is what you bought unloved in year one, year two, year three, all the returns come in year four. Then what happens is then year five or year six sometimes is a problem. That's all. Otherwise, finally, at the end of the day, if you're going to buy where everyone is buying, then you are overpaying for it. This is our learning, and so that's why if you have a fund where you have done too well between let's say for 4 successive years, then there can be a period where the fund does badly. Otherwise, this entire process of contrarian investing or value investing has proved itself to be right for long periods of time globally. So in 2020, people or 21 people said globally it's gone. And now it's only time for FANG stocks and nothing else other than FANG stocks. But look what happened even globally. So what we believe is that there is a certain requirement of patience. Most of the time, investors don't need the money overnight. But because the mutual fund industry promises 100% transparency and redemption overnight, the NAV is known that that actually results in a situation where people see their NAV and get worried. But as long as the investor is long-term, the investor benefits by being patient. But we are not people who can guarantee every month that we will do well, or every quarter that we'll do well, or even a year or two when we'll do well. But the whole concept is you buy cheap relative to intrinsic value. And when that intrinsic value, when the market moves towards intrinsic value, is not in our hands, because that is not our job. Our job is to buy cheap relative to intrinsic value. And that is the framework that is set in the framework of buying value investing, which has worked over decades globally. So why should it not work in India? And that is the principles which has worked. If you look at, Nilesh was in ICICI when we launched Value Discovery. And over the last 19 years that we have seen Value Discovery, there have been 2 patches of 3 years where there has been a problem. But otherwise, it has worked.
Absolutely. That's so well articulated, Naren, because, we've seen this, at different times where, people were writing off value, but, I think, just that sticking to the process, ingrained in the philosophy that you run has paid rich dividends over, the various market cycles. Moving in terms of, the next triggers for the market, Nilesh. So obviously, when we think about just purely from the lens of valuations, while we've had some correction, we're still probably trading a little over long-term historical averages. So what are some of the triggers that you think, perhaps in the, medium term can really play out from a market's perspective?
So right now in our market, we are trading somewhere around historical average valuation. But please remember that in those historic average valuation, interest rates were little lower than what it is today. Right now, market believes that interest rates will start coming down somewhere in 2024, and probably still believes that equity market is at historical average valuation. But it is not our historical average valuation, but relative valuation to peers where there is a challenge. I will call this as a 3-idiot moment in our market. If you remember that iconic movie 3 Idiot, Professor Virus put Amir Khan, Sharman Joshi, and Madhavan on one line and said that anyone who steps up will get this particular job. Sharman Joshi kept on standing where he was, but both Amir Khan and Madhavan took a step back, pushing him higher. The same thing has happened in our market. We are trading at our historical average valuation, but all others have fallen behind. And that's why gap between us and them have increased significantly. Now, this gap means investors have more expectations out of India. They expect our earnings growth to be better than our peers. They expect our governance standards to be better than our peers. And they expect our green commitment, our commitment to environmental and social, to be better than peers. If India delivers on this 3G, growth, governance, and green, then my feeling is that we'll sustain this three idiot movement valuation and continue to deliver return to investors. If we fail to meet expectations of 3G, green, growth, and governance, then certainly our markets will get derated. Fortunately for us, there are many companies within our universe which are capable of delivering on 3G. And hence, we believe India will be an outperformer to the emerging market. It will reward investors, albeit with bouts of volatility in between. Please remember that economy and markets can behave differently in the short term. Markets will be driven by flows and sentiment apart from fundamentals. And hence, there will be more volatility in markets than in economy.
Right, sure. Thanks, Nilesh. Just taking forward, the relative valuation point that Nilesh made. Naren, the one thing that we've obviously increasingly seen that the days of easy liquidity, global liquidity are behind us. Sure, we're relatively more expensive, and we've seen the FIIs have probably been pulling out from Indian perspective. Do you think we're kind of there with Atmanirbharta in terms of domestic flows? And what's really led to this change in the domestic flows? If you could share some insights.
I think the domestic mutual fund sales machinery has concentrated on SIPs, and I think they've done a brilliant job there. And I think they have managed to create this culture of SIPs. The second, clearly, I would say, is that the entire EPFO and NPS movement that has happened over the last 5 years has also brought stability to the mutual fund inflow over the period. I think this combination of EPFO, NPS, and SIP has clearly helped the mutual fund industry significantly in terms of flows. And that is the reason why the markets have also been more stable in the year 2022 compared to most global indices. And that is the way we look at it. Having said that, the way we look at it is part of these monies actually used to go to debt. And whether it is EPFO, it was 100%, NPS was 100%. And all this money which comes into SIP, all those monies were actually monies which were going into debt. This means that the amount of money which is going into debt was lower, is lower. And earlier it was in 2020 and 21, maybe it was not required because of the surplus liquidity environment which got created out of COVID. Now, I think this would mean that actually the debt market needs more money, and therefore debt becomes a great asset class, coupled with the fact that the printing presses in US, Washington, and Brussels have stopped. There are only 2 printing presses which seem to be working, which is in Tokyo and Beijing. So we believe that that has resulted in a situation where debt becomes a more interesting asset class. And if the Tokyo and Beijing printing presses also were to stop, I think debt will become an absolutely outstanding asset class. And that part of the fact is not fully understood by people, because for a long time, from 2008 to 2021, you had 3 unlimited printing presses printing money: Washington, Brussels, and Tokyo. And out of these 3, only 1 is now printing, which is Tokyo. And that also may change. And if that changes, we are in an environment where debt becomes a great asset class for investors. So actually, people should consider debt more than they did for 13 years, because in that period, you have to remember every Indian corporate could borrow at 0 globally. Today, when they borrow globally, they have to pay 6%. And that's a big change from borrowing at 1% to 6% is a big change, if you ask me.
Right. Absolutely. And just taking forward that point, Ren, we saw the results of the poll also in terms of people are looking to focus or sticking to the asset allocation. What's your advice to investors today in terms of when they're looking to construct a portfolio for the next many years?
See, our models are suggesting gradual increase in equity allocation. And if you look at it over the last 6 months, it has been slowly increasing equity allocation. If interest rates by chance were to start falling, then actually it would have increased much, much more significantly. Because if you look at it, Sensex touched 60,000 in September 2021. For 18 months, it has been hovering at the same level. So our models are actually suggesting increasing in equity. Barring the fact that interest rates had gone up, it would have actually focused on increasing much, much more aggressively into equity. That is why if Fed were to change their stance and say, I'm going to cut rates, it would actually suggest much more aggressive investing in equity. Because interest rates are going up in India also, it is saying gradual increase in equity allocation is what our models are suggesting in the products that we run, like Balanced Advantage Fund or Asset Allocator Fund of Fund. That's what it's doing at this point.
Sure, thanks. Nilesh, similar question to you. And one is, what's the advice for investors? We've seen a lot of DIY investors enter the markets over the since the COVID pandemic, who've probably never seen a true blue, bear market, entering equities, probably buying direct stocks. What's your advice to them? And which segment of the market, large, middle, small, do you think relatively is more exciting from your perspective?
So my question to all the do-it-yourself investor is, do you go to barber for a haircut or you do it yourself? For as mundane thing as cutting hair, you trust professional. Then for as serious thing as finance, why do you want to experiment? I have rarely seen a patient who will go to medical shop and seek medicine. They always go to doctor, show them symptoms, take prescription, and then go to medical shop to buy. What you are doing for your physical health, you have to do it for your financial health. Now, every rule has an exception. There will be certain investors who will be extremely smart, extremely intelligent, and hence they can do it themselves. But for ordinary folks, it is important that we go to financial advisor, lay out our objectives, understand our risk profile, and get a prescription of investment which helps secure financial freedom. For every investor, there are only 3 things to do. 1, be a regular investor. Little drops of water make an ocean. The same thing is true in SIP. I'll share a very small experience. All mutual fund managers and sales personnel have been pitching SIP. I have been also doing the same. A colleague of mine at Axis Bank had started SIP for his driver few years back. That driver left the job but kept the money with my colleague only. Recently, when he came to give his daughter's wedding invite, he requested that money to be returned. And my colleague simply opened the app, looked at the NAV, and said, this money will be deposited into your bank account. The driver had tears in his eyes because he never imagined that kind of money could come. For every person, no matter how rich or poor they are, there is a solution in regular investment. Do remember, little drops of water make an ocean. The second thing is about long-term investment. If you want good mangoes, you have to wait for 12 years after planting mango tree. Miracle doesn't happen. You have to be a long-term investor to ensure compounding works for yourself. And third thing is discipline. You don't put all eggs in one basket. Same way, your investment has to be diversified based on your risk profile and investment objective across debt, equity, commodities, real estate, and offshore. Follow these three things: regular investment, long-term investment, and disciplined investment. I'm sure financial freedom will be secured.
Yeah. So thanks, Nilesh. So we're almost out of time. I'd love to take a few questions from the audience. So Nilesh, maybe first to you. In terms of there's a question from Indradeep Pal, where he's talking about are the global rating agencies probably giving India slightly short end of the stick, or are they being fair in terms of the country risk and the rating that's there on the sovereign basis? Just your take on that.
The name of the rating agencies are moody. So their mood keeps on swinging when they rate white country versus brown country. And rating agencies also have very poor standards. So it will be unfair to expect that those rating agencies will treat everyone equally. Let's remember there is a financial apartheid in the world. If we were doing money laundering for white men, we will be called terrorist nation. But when the white countries does money laundering for emerging market crooks, they are considered heavens. So let's remember there is a financial apartheid. No one is going to treat us fairly. Other than your mother and father, no one is going to treat you fairly.
Sure. I think that's a very interesting perspective, Nilesh. Thanks for that. Just quick last question, Naren, to you in terms of the new age companies that we've been seeing, over the past many years. Obviously, there's been a lot of euphoria and then, reality check. Just your take on, how do you see the space evolving?
Very interesting now. The first few new age companies, they launched their share prices at X level. Some of them got it wrong. Then they made some governance mistakes. Some of them crashed. So, due to that, now every new age company has to come at a more reasonable price. And that has made it much, much more pleasant for all of us in the mutual fund industry. I think new age companies will also do well. It is not that they are not going to do well. If you're going to use those products, they are going to do well. So I think it's a very healthy development that the first 3-4 companies actually failed in the stock market. If they had succeeded in the stock market, just like US, what would have happened is 100 companies would have got listed at absurd valuation. Now those first 4 failed. Therefore, most of the others, they will come at much, much better valuation. And therefore, we will have a much better, pleasant environment to invest in. And today we are able to ask all kinds of questions to the new age companies which are considering listing and the companies which have got listed. So there were companies which are saying, we don't need Indian investors also. So even they are willing to come now to meet us, because at the end of the day, they've realized that, you need to present a cogent story. Some of them didn't know how to behave as listed companies. So that also is changing. So it's a very, very nice development what has happened after 2021. I was fearing it because see, first, we didn't know how to value them. Second, we didn't know how these companies will behave after listing. Third is if they had shot up, people would have said, all you old fogies don't know how to look at these companies. Luckily, the way it turned out was very good for all of us in the mutual fund industry, that we are having a very pleasant experience.
Right? Yeah, I think we've run out of time. I would love to continue the conversation and we could go on for hours. But, Naren, Nilesh, it's been an absolute pleasure as always speaking with both of you. And, I can say with a lot of confidence that our viewers go back with a lot of learnings, which will really immensely benefit them when they're looking to construct their portfolios. So thank you so much for your time. It's been a pleasure speaking with both of you.
The pleasure from our side as well.